Next, we'll delve into a critical discussion about funding growth for homegrown businesses with our third panel of the day, the road to public and private markets for homegrown businesses. In this session, we'll explore strategies for accessing both public and private markets and get perspectives from investment bankers, wealth managers, and VCs. This will be very interesting. Now, please join me in welcoming our esteemed panelists to the stage. First, Rabih Khoury, Managing Partner and Chief Exit Officer at MEVP. Rabih brings decades of experience in venture capital and private equity, having executed over $5 billion in transactions across MENA. Rasha Othman, EVP Investment Banking at Markaz. Rasha leads high-impact capital market strategies and investment banking initiatives, driving growth and innovation in Kuwait's financial sector. Dalal Shaye, as SVP of Alternative Investments at Kamco Invest, Dalal oversees diverse asset portfolios focusing on strategic allocations that maximize client returns in alternative markets. And lastly, Steve Khayat, Founder, Managing Director, and CEO at Phoenix Venture Partners. Steve brings expertise in venture capital and business development, guiding high-growth startups in the tech and investment space. So let us start with the role of wealth managers and private bankers. I'll start with Rasha. As EVP in investment banking at Markaz, how do you guide institutional and private investors when evaluating opportunities in capital markets? And what key factors are you looking for in homegrown businesses seeking funding?
Thank you. Well, I come from an investment banking background, so I'm not a wealth manager, but I deal a lot with wealth managers. For investment bankers, one of our core services is to provide or to facilitate funding for our clients, corporate clients, basically. And for us to do that, we have to, first, we go through a process, and that process starts with understanding the objective for funding. Sometimes the objective can be for growth, it can be for capital expenditure, it can be for even to address some financial challenges. So it depends on the objective for the funding. Once we understand that, we move to the next phase, which is the due diligence process. And that we cover financial due diligence on the company. We understand the business model, the drivers for the business model and for the company. Of course, the financial due diligence is important to understand the financial health of the company, their profitability, their margins, their cash flows. That's important. And of course, the overall economy and the overall performance of the sector in which the company performs in. So once that is done, we try to structure a product or a financing mechanism that suits that company, and so it's really custom made for them. And we try with that not only to meet their financing objectives, but also we try to optimize their capital structure and to maximize their financial stability. Once that, of course, we use different tools for that. If I may say, we use equity. It can be common or preferred shares. We use it could be debt, whether plain vanilla or convertible or a hybrid of both. Once the product is ready or the financing is ready, then we go to our wealth management team, where they approach their investors, whether the institutional investors, the likes of the sovereign wealth fund, and these are. Well, it depends. Usually, the investment objective for institutional investor is different from private investors. The sovereign wealth funds usually are the ones with the large sums. They have more sophisticated investment strategies, so they They do invest in long term. They can invest in venture capital. So they have higher usually risk for tolerance versus the private investors, where the likes of the family offices or the high net worth individuals, and these are usually more medium term. The risk tolerance is probably less than the institutional investors. But when we go to these investors, basically we offer them with all the information, the due diligence we have done on this company. We explain the structure, and most importantly, we explain the risks for these so that they can make an informed decision. So this is how we help corporates acquire funding from different sources.
And Dalal, how do you approach alternative investments in local companies? What advice do you have for businesses seeking to attract long-term capital?
In terms of alternative investments, we always say to our clients that you should have a diversified portfolio. الحين أحسن؟ احنا دائما نقول حق العملاء لازم يصير يعني you have to have a diversified portfolio. طبعا نتكلم عن like Rasha said, several wealth fund, financial institution, holding companies, and family offices. You should have investing in the liquid and illiquid part of it. So when we define an alternative investment, which is the part of illiquid investments, it goes back to real estate, it goes back to private equity and venture capital. ويمكن في هنقول مثل mix between the private equity and venture capital, where venture capital you can define it as investing at the early stage, and when you define the growth and late stage, it goes back to private equity. So having this diversified portfolio where you have the income generating asset, the public assets, and then you have the illiquid for the capital gain and the capital reservation for the longer term generations, let's say خاصة للfamily offices. It's very important to have such investments. طبعا وتختلف على risk and return profile for each investor and type of investor. So what you prefer to have more in your portfolio? Is it the illiquid part of it or the liquid part of it?
So Steve, I want to ask you, as the founder of Phoenix Venture, how do you position businesses to meet investor expectations for both capital and growth potential? What role do private bankers play in guiding founders through this process?
First, thank you for having me. Okay, thank you for having me. I think you have two questions in one, so let me address one by one. So first, to position, I mean, you have plenty of investors here, both private and institutional, and it's all about optics. So you need to, what we do is actually support, homegrown businesses, they have their own set of challenges. So first, we need to, we invest in high growth sectors, but we need to focus on a path to profitability alongside the path to growth. And this is achieved through a number of things. First, we need to have a proper market fit, both on the founders and the product. So that is done through a lot of research. And second is actually building a scalable business. What I mean by scalable, it's a word widely used, but to actually be able to grow a business without a proportional increase of costs as you grow the business. And this is the challenge. Second thing, you need to have operational efficiency, like real operational efficiency. And this is done through being lean, and investors keep picking on founders, on that. And the second is actually being able to maintain costs in check. And this is done regularly by revisiting quarterly or semi-annually, looking at your expense structure and what others are doing in competition or otherwise. The second thing is building a fundable company. Okay, so building a fundable company, you may have a great idea, but it's not fundable. And Rabih knows best across 2 decades of investing. And how you do that is actually by first having a proper strategy in place, long-term strategy for the company on how to grow across the phases. And two, actually homegrown businesses cannot grow just by themselves, just like that. So you need to forge strategic partnerships. And this is where we leverage our international network, our regional network, to also first have collabs, which will have them tap into new markets. And the second is to surround them with a plethora of mentors and advisors. And this is very crucial in the early stages of a homegrown business to actually start becoming a brand. And secondly, on creating a fundable company is actually having a long-term fundraising strategy within the financial strategy of a firm. So financial planning is good, and we help them and we mentor them, just like IP strategy. And we keep saying that it's all about the forecast and meeting those forecasts, which is essential, yes. But I see a lot of founders just talking about their pre-A series and have no clue when would the Series B kick in and why, and when would the Series C kick in and why. And these are mismatches, honestly. And I mean, Noor, everybody spoke about that, Sakadumi. It's a reality that homegrown businesses need to fix. And having a, from some family, friends and fools to seed to VC to growth to pre-IPO, it's a long way. So these are the two aspects where we help homegrown businesses tap into the right optics for investors. Now, for private bankers, you were saying private bankers, right? Your second question was about private bankers and their role?
Sorry?
Your second question was about private bankers? And
about guiding founders through the process.
Yeah, so unlike investment bankers, so I myself have been in the past 2 decades both an investment banker and an VC. So investment banking has a completely bigger role to play than private bankers. However, private bankers still have, I would say, a pivotal role in access for founders in 2 ways. First, founders need to keep private bankers close to them for 2 reasons. One, because private bankers manage multi-generational wealth and family offices. So they know what matters most to family offices, which remain one of the key players in both private and public markets. So first, they will groom or actually help the founders set expectations on what is to be seen in the early years, so that to make their investment attractable, and they can help them create a cohesive narrative into what investors are expecting, which is really for patient capital, a very steady. Things change slightly over time, like Hanadi was saying. The technology changes, but the same approach is done on investing. And second, private bankers will give homegrown businesses founders access to capital, much needed capital in the early days. And these are the 2 roles that I really see for private bankers, unlike the investment bankers who have a much wider things to do.
So, Rabih, Steve made a great job at giving us a kind of overview to all of that. But I wanted to know from your side, what guidance do you offer startups or early stage companies to align their business models with what private institutional investors seek? What advice do you give them for Rasha or Dalal to actually look into investing in their companies?
Well, first, thank you for having me. Kuwait has a very special place in my heart. I was born here, lived here for 10 years, went to the French school, École Française. So what I would give Rasha and Dalal advice is to invest with MEVP, which they have done. Markaz is a big investor with us, Kamco, Burgan Bank, Rasamil, the Sayer family, the Shaye family were one of the first regional VCs to market our third fund in Kuwait. And we had a lot of support, and we really appreciate it. In addition, one of our leading portfolio companies, Anghami, recently acquired OSM Plus also, which was a very important transaction for the region. So what I advise is, investors, similar to what Fahad said, is that VC is a very important allocation in a portfolio. I believe that it should be the major part of your alternative assets. I think it's much more interesting than hedge funds. And in the region, it has definitely done much better than private equity. Private equity has some structural issues in the region. You need scale, which is difficult. You need non-recourse debt, which is non-existent. VC is borderless. You can create regional champions very quickly and get scale, which is very important. And following up on what was said on the previous panels, we at MEVP invest regionally, even though unfortunately we raise money locally. There's a bit of a mismatch. Our fourth fund that we launched last year was anchored mostly by European money, which is a bit sad. We're by far the leading VC firm in the region, private sector VC firm. And we had to go get money from European Investment Bank and from Delivery Hero, for example. We would like to see more participation from the sovereigns. However, the sovereigns also tend to invest locally. I have a funny title. I'm the chief exit officer. It's easy to invest. It's very difficult to sell. And to be able to sell, one of the themes we have at MEVP is to create a regional champion and then attract a strategic who comes to the region. It's difficult to build in the region. Where do you start? In Kuwait, in Dubai, in Abu Dhabi, in Riyadh, in Doha. By providing already a reasonable digital platform, the build versus buy becomes much more interesting because life is too short, especially if I had in VC. We need to move very fast. So this is one of the themes at MEVP is to build a regional platform. And then you can exit. Even Saudi Arabia by itself is not a very large market when you compare it to India and China. But then when you look at the GCC and the Arab world, now you have scale. The other thing that's interesting is that people always ask me, what companies do I invest in? We invest in companies that actually make money, right? We invest in venture capital, but at the end of the day, we need to make money. Our fiduciary to our investors, like Dalal and Rasha, are returns. So how do you make money? We invest in a portfolio. And this is something also that some of the people who want to do direct investments maybe miss. We at MEVP guarantee a return on a portfolio, not on an individual company. Our typical portfolio is 12 to 15 companies that we hold typically around 4 to 6 years in a 9-year fund. And we believe that we can deliver a return on a portfolio. And that's why, especially in the early stage, it's a bit dangerous to do direct investments, especially in the region. The US, as Fahad knows, is very different. You have much more liquidity avenues. It's one big market, one law, one currency. The Arab world is multiple currencies, multiple laws. So this is what we advocate. And as we've seen recently more IPOs, which is great. However, IPOs tend to be really a minority investment in private markets. We hear about them because they're public. But by number of transactions, 90% of transactions are actually private sales. So we need IPOs because we have a very large investment today in the Arab world and our technology sector. But our technology sector is not represented in our public markets, which is a big mismatch. I mean, today, there are basically 3 companies, public, in the whole Arab world. 3 or 4. Khoury in Egypt, Jahez in Saudi Arabia, Razan in Saudi Arabia. And then, inshallah, soon, the Taiba H IPO, we'll see. That's not enough. And this is a mismatch. When I look at my children, I have 2 boys, twin boys, they're 15 years old. Once they're going to start investing, hopefully in maybe 4 or 5 years, they only understand technology. And if we do not show them a public market that reflects our economy, they're going to invest outside. And we're going to lose this new young generation of hyper-connected kids in the Arab world, especially in the GCC.
I would like to come back to your role as exit officer, but before that, I would like to ask all panelists, how do you see the influence of private and institutional investors shaping the journey of homegrown businesses as they approach public markets? Rasha, from a capital markets perspective, what are the investor expectations that businesses should keep in mind if they aim to reach the public market?
Let me start with saying IPO option or IPO route is key for companies that are looking to raise funding. It provides them with a better access to capital. Definitely, it provides a deeper pool for liquidity. So it also achieves strategic objectives, not only for funding, but for instance, we have family businesses that have succession issues. For instance, IPO addresses that. We also have, for instance, private equity funds that are looking for exits from their investments. IPO also addresses that. And most importantly, the governments actually that are looking to diversify the economy, they're looking to increase efficiencies in their economy, and so they go for privatization. IPO is one way to address that. So IPO really is key for the capital market, for the companies, for funding as well. And that's why we have actually, Rabih said, there aren't enough IPOs, but in recent years, there has been a tremendous increase in the number of IPOs. Since 2016, more than 190 companies were listed on public exchanges in the GCC, around the GCC, with around 85 billion raised for these IPOs. That's not a small amount for the region. I agree the technology is not very widely represented in these, but it's improving, and I think it will. Investors are starting to understand more about technology companies. So what investors are usually looking for in companies that are looking to go public, these mainly what we call that they have to be IPO ready. Private companies that tend to, intend to go public, they need to articulate their equity story. So this is what investors are looking for. They're looking for an attractive equity story, compelling one, meaning that they have a robust business model, that they have diversified revenue streams. They're financially healthy. Their capital structure is optimal. They have healthy margins. Their cash flow are positive. Of course, the overall economy, the conditions, the sector, the market, it affects. But what private companies miss or they don't pay attention to, and it's extremely important for them to be a public company, is corporate governance. That's something that investors want to see in companies, that they are compliant, and it increases confidence in them. Corporate governance meaning that they have an active board, the board has defined roles, that they have financial management, budgeting, risk management policies. These are key for companies that intend to go public, and of course, fair pricing, and that's really important.
Steve, you were nodding your head when Rasha was talking about ready for IPO. Is that your perspective on what makes them more attractive for investors?
Actually, your primary question was about the role of investors, right?
Yes.
In that context, this is one of the primary roles of institutional investors, which come quite after VC. So because, let me take a step back. In the early private investors, their role is to provide patient capital and to give enough flexibility for founders to iterate and find the right setup for their business and help them, because the business idea is always great, but it's about, not only building the right business model, but actually matching it with the right revenue model, and many times it's not matching. And they provide them with resources and mentorship. So this is family offices, angels, and VCs, right? But as she was saying, Rasha, the institutional investors, I'm talking about private equity, sovereign wealth funds, pension funds, their role is obviously to make large-scale investments and accelerate growth, just like Fahd was breaking up the segments of the market. But more importantly, and of course there's a rubber stamping of market credibility, but more importantly is that IPO roadmap, this IPO readiness. And it is expected of institutional investors. It's not the other way around. We help them throughout the stages of governance. The first boards are formed by VCs. The first governance, VCs help founders, navigate the regulatory requirements sometimes getting dual regulated. Let's say it's a fintech play. It's the Tamaras and the Tabis of the world. They need the SAMA, they need the Kuwait Central Bank. It's very difficult. But then one of the larger expectations is that the institutional investors should provide that guidance and roadmap to IPOs. And to Rabih's point, one of the major premises of not having enough IPOs is actually this lack of guidance. Let's say it's how it is, and these institutions being not proactive enough, or they're quite passive in the hand-holding in that phase, just like VCs do their part in the early stage for readiness for growth stage. Institutionals need to do their part in preparing companies for IPO. This is not only by diversifying the cap table and institutionalizing or consolidating, or there's a whole governance setup. And it's not just about hiring one of the big fours to set the IPO roadmap. It's actually, it's cultural, leadership, mid-management, all the way to granular parts of the business. And it may impact both the business and the revenue models as you go to that stage. So this is why I was nodding to that point.
Are these qualities that make a business attractive for you to invest in?
I may comment on that in terms of the technology companies, because I'm focused more now on tech, so please, I may speak on that specifically as a class. So what we have now in the region is developing, right? We have let's take a step back in 2017 and 18. We have a lot of ideas, very good entrepreneurs, great founders with great early VCs, such as MEVP. And yes, we did invest with you. Maybe you were one of the earliest VCs in the region, right? So, but there was a lack in the growth and late stage capital. The tech companies, to be needed to be publicly listed, they need to grow and they need to scale in a way that they are eligible for the criteria for the public markets. طبعا regulations بالمنطقة الخليج في السعودية وفي الكويت والUAE was not helpful back then. Nowadays there is a lot of supports that being given by the regulator to eligible those tech companies to be publicly listed. In 2018 Saudi they launched NMO, which is a parallel market to Tadawul, but everyone wants to list in Tadawul because of the liquidity and the depth of the market. So again, they're trying to support that and change or ease the regulation in Tadawul to be able for those companies to list. So I believe this is a normal, we're developing, the ecosystem is developing. So if back in 2012 and 2013, but in 2017 and 18, it was much more active, let's say, within the funding, and the growth and late stage funding was funded by the government or the VCs in 2020 and 21. Now we're seeing that. We're seeing those late stage companies that they want to publicly list. There was announced like 5 or 6 companies, they did their pre-IPO round, and they're supposed to be publicly listed within the next 2 to 3 years. So I think this is a normal cycle for a merging VC ecosystem. But let's say the growth that happened in the region, the pace of the growth is much faster than what we saw back then in the US or in Europe itself.
I feel that companies grow quickly, but coming back to your role as exit officer, the growth happens really fast in the beginning, and then they have the choice between exiting or IPOing. And we find that the rate of progress starts to slow down. So how do you assess whether a company is ready to IPO?
Any company that can IPO should IPO. Your question is, there's a truism in investing. Companies are not sold, they're bought. Okay, a good story will IPO. However, again, we have some structural issues in the market. If you look at IPO investments, in Saudi Arabia and the UAE, and I believe so in Kuwait, it tends to be dominated by retail investors. This is not great. It's volatile. We haven't seen institutional investors coming in and anchor IPOs. They can probably do it in the pre-IPO realm. It's easier. I mean, Kamco is working on a pre-IPO fund. Investcorp announced one. Abu Dhabi has something called the Abu Dhabi, IPO fund, and Sanabil has, listed probably 10 Saudi champions that are going to list in the next 5 years. So my issue is not whether we can list companies. The IPO market right now is not ready for us for a couple of reasons. First, you cannot list a money-losing company in the Middle East. Am I correct or am I wrong? But Numu is not. Numu was never designed for that. Jahez was too large for Numu. They put it on Numu because of some regulatory issues. So it's difficult to list a money-losing company. In the US, most technology companies, when they list, they're losing money. And this is where the regulator has to step in. My suggestion to the regulator is qualify the investors, create a qualified investment threshold, but don't opine a lot on what companies can list, because certain investors will want to take very early stage risk. The other thing that's missing, and this is not just about technology, we don't have enough research, right? I mean, research is very important, okay? We don't have very sector-specific research, okay? Also, you want and maybe this is the sovereigns or the big asset managers, to hold their pre-IPO investment or allocation IPO through the first, let's say, year, to be able to stabilize the trading. So there's a lot of work there, but I'm not concerned about that. I'm concerned about capital available to create some of our companies to become IPO candidates. We used to have bigger PE firms invest after us. Most of the PE firms in the region have disappeared. And we have to move from doing A's and B's to doing C's. We need another layer of pre-IPO investors to take the legacy from us and be able to take these companies forward. Now, I will guarantee you, and you mentioned that, is that companies out of the MEVP's portfolio are governance ready. This is very important, okay? We don't need, the eyes of an investment banker. And by the way, I'm a reformed investment banker, okay? So we, at least from our portfolio companies, our company are, governance ready. We always instill that, our investment documents also force entrepreneurs who, accept money from us to instill all these pieces. So I'm not concerned about that. But maybe we need one regional market for the whole GCC, for example. A deeper market, more liquidity. So most markets are not very large. And, when we listed Al-Ghami, this happened in February 2022, we could not list it in the region. We had to go merge with a SPAC listed on NASDAQ with all the risks of SPACs. I'm an expert on that. But, and then, Swivel out of Egypt also had to go to NASDAQ. Before that, people, Network International? This was a big fintech, PE play. Abraj bought it from Emirates NBD. They end up listing where? On the London Stock Exchange. The IPO never did very well, even though it's a very solid company. They recently went private. So we have a lot of work to do, but I'm in venture capital, so I have to be hopeful. If I'm not hopeful, I will not invest in anything. And the future is bright. We need younger people. We need more young investors.
Yeah. I'm glad you touched on research, because you were talking a lot about technology companies, and Rasha and I had this conversation previously, which is looking at how technology companies are valuated today, on what basis. You hear crazy numbers coming out, but what is it in relation to? So I would love to get all of your opinions about how today you see valuations of ridiculous amounts, but we don't know for what.
So you think the valuation of OpenAI at 150 billion is ridiculous?
Tell me why.
Let me give you a number, interesting, okay? And let's talk about the US. Who knows what's the budget of the Pentagon in the US? per year. $800 billion per year. And then if there's a war, there's special allocation. How much was spent on investing in AI in the US last year?
How much?
$200 billion. Okay, so value, and Fahad, on your chart, so there's something that people forget. When OpenAI reached $150 billion valuation, the actual money into OpenAI was about what, $22 billion, Fahad? Right, okay. So VC tends to be valued on the margin. OpenAI did not attract $150 billion of money, okay? Now, valuations is always this question, this, we negotiate valuations. Our issue is not valuation. Our issue is whether this company can exit.
So timing.
Yes, but not just that. The exit situation is always very complex. First, you need enough funding, right? And sometimes because of some consolidation issues, we cannot keep on funding the same company. So we need more, club deals, okay? So the way we look at valuation, obviously we see a lot of valuation in the US. And this is one of the issues of not having enough public technology, public companies in the region, is we do not have local multiples. We have to go get multiples from NASDAQ, and then they become Frankensteins, right? Because you adjust at least 5 ways: size, liquidity, political risk, currency, right? And then you end up with this multiple, and then you try to apply it. Valuations in VC go up and down like any other sector. Today, maybe AI is expensive. The other sectors are not. And by the way, AI, one of the themes of this conference is, women empowerment. You know what AI thinks of us as people? Not as women and men, as a species, okay? You guys have no idea what this AI thing is going to do to us, okay? Men and women. So no, I don't believe valuations are very high. We have cycles in VC. They tend to be led by a much larger economy, which is US. That's very liquid, that has, the biggest public market and the lowest cost of capital. Rasha, when you mentioned, when you were giving the characteristics or the advantage of going public, when you go public, you reduce your cost of capital. Our cost of capital on an individual company in the early stage is probably 50%. When you go public, your cost of equity is probably 10%. So you can be much more efficient. In addition, if you become profitable, you can raise debt. And you can reduce your weighted average cost of capital. Anyway, sorry, I'm rambling.
No, it's lovely to get that insight. But Rasha, you've also shared some insight with me previously about the whole valuation of companies. If you'd like to share that.
I want to comment on the technology companies, because I think Rabih addressed that. But usually, valuation is a key component for IPO. I mean, for the attractiveness of the IPO as well. Set aside the technology companies, and I think investors here are still, as I said previously, to understand the technology companies and how they are valued, because we have a couple of transactions, and we try to approach investors, and they just don't. There is a lot of education to be done for investors here. I agree with Rabih on that, definitely. But for other sectors, I think valuation is key for the success of any IPO. Of course, the methodologies, they differ from one sector to the other, but we always advise on using more than one methodology, and we always advise and recommend our clients to tell a compelling yet a very credible story about their profit and growth. They can't just, because X company was priced or valued at this number or multiples, then they have to be the same. Each company is different, the sectors are different, the drivers are different, so they really have to be real about that. And we have seen IPOs that the valuation not only increases the demand for the IPO, but it also sustains the investor. I mean, you're saying institutional investors. There are a lot of mutual funds actually in the region. In Kuwait, definitely all mutual funds are interested to invest in IPOs. I mean, 85 billion in a few years is not a small number to be raised in the region. So there are institutional investors. I know the sovereign wealth funds, they do invest in IPOs as well. But the valuation issue is key. Companies and promoters, they have to understand, they have to know how to keep it real for investors. So post IPO, the price doesn't dip, and it happens a lot because probably it was overvalued.
Yeah.
And we have seen that. So that also sometimes it, investors, they want to shy away. They don't want to invest in IPOs. So it is, valuation is key, and they have to look seriously into it. I mean, the promoters.
So, Steve, how do you guide portfolio companies and prepare for potential fluctuations in valuation?
It took me back to university. The first question I asked my evaluation professor, how accurate it could be. And he said that you have to live with the fact that the moment you start evaluation, it's wrong. Because you have a cutoff in data historically. But Rabih has rightly said, and Rasha has rightly said, valuations go up and down, and you have to adjust. And across the four levels of valuation, the book value, the fair value, the market value, the last two are very interchangeable. And so for us to protect them from fluctuations, number one, أولاً وآخراً أدعو دائماً ونكرر financial health and resilience. There's no beating a strong balance sheet and good cash reserves, because this allows you to avoid a down round or a downturn and stick it out. You just shrink a little bit your cash burn and wait it out a little bit. So there's no better than that. And also diversifying your revenue streams. So you cannot be stubborn about your revenue model. You need more than one. First, the revenue model must have recurrence. So you should have, things like subscriptions, so that when you have recurring revenues, it's predictable income, and that can help your investors see the real value or the fair value, irrespective of the market value. Because sometimes when in tough market conditions, some founders or homegrown businesses go back to their initial investors and make an internal round just to bridge a period, and then we go back. And sometimes and this is achieved through healthy communication. So investor relations is another key element that we push our investors or founders to maintain. So you need, just like Wafa has mentioned a while back, that she maintains a quarterly update. This is very healthy. But also set KPIs and communicate on them to show your investors, VCs, family offices, whatnot, of the progress you're maintaining, irrespective where the multiples are at. Okay, and so this is a second thing. And also, when we speak about scalability, it's both ways. So a business needs to be scalable up or down. You need to listen to the market and know when to shrink. We always listen, founders, in a very relaxed manner, speaking about expanding horizontally and vertically. Sometimes we see DEX, naively assuming that their cash burn will cover expansion in both UAE and Saudi Arabia, two huge markets with endless challenges. So one of the ways to maintain that in check is actually have a strategy. نفس ما بيقولوا على دم بارد. So on a cool mind, early on in the setup of the business itself, the business model, the revenue model, how they work together, you need to have long-term strategic planning. To focus on the long-term goals and not have quite quick reactive, jerks of business movements that capture short-term gains. But more importantly, plan a number of strategic alternatives, a number of strategic scenarios for each different market condition, so that you have a playbook. If I hit this downturn, I need to shift to that strategy. If I hit a soft landing, I'm shifting to that strategy. If there's rapid growth, I have to shift to that strategy. And these are better done on a cool mind rather than in the moment. And finally, for those companies who are actually planning to go to IPO, if it's in their mind, you have to have IPO readiness. And then sit and wait for the best market conditions. And it's not always about the best valuation. Sometimes you have an okay valuation, but you have an excellent market maker that will have a post-listings market stabilization that will maintain your price by creating breadth and depth and enough volume to maintain your share price, not like some unfortunate listings that plummeted after the listing. And so if you are IPO ready, you and your investors and your boards and your stakeholders are actually sitting and waiting for that moment. And when that moment happens, your application to the CMA or whoever, Borsa Kuwait, whoever you want to apply to, is going to be swift because all the ticks of the boxes are ticked. As opposed to, oh, the market is ready, let's go to the pain of IPO readiness, and then volatility in the valuation will, I am ready, but it passed. So wait for the next round, and it's painful.
Yeah. Dalal, what do you think is the most critical factor for long-term success post-funding? What is the most critical factor for long-term success post-funding for a business? Post-funding.
For
long-term success post-funding for a company,
Yeah, for a company. Yes. Now we at Kamco, we're not venture capitalists, so we don't invest at the early stages. We invest at the growth and late stage. Maybe to define that, we have to define first what we look into those companies, so that and the strategy of the investor itself, so that the investment, are we going to hold the investment for the next 5-6 years, or we're going to hold it for the next 2 to 3 years? Both growth and late stage, we usually would like to invest in companies that the total addressable market is very large, that you can scale this company and expand it into different jurisdictions and to have the recurring revenue. But the most important factor is the path to profitability. Maybe, Rabih, as you mentioned, the regulation in the public market are not before. They don't, especially I'm talking about in Saudi, they don't allow companies, loss-making company, to be publicly listed, but they're trying to changing this regulation in a way that at least show us that you have a 12-month of runway and you can list, even if you're not profitable. So it's different depending on the strategy, but usually we Kamco as a financial investor with the experience that we have, we usually would like to add value to the companies that we invest with, especially for the companies that want to go publicly listed, because cleaning the cap table, especially for the VCs, when the company is ready to be publicly listed, most of them they hold the company more than 8 and 9 years. They need to exit. So most of the early VCs may not stay long until the IPO. So when the company is ready for the IPO, then here where the financial institutions and PE investor have to step in and to help the company for their journey to be publicly listed. They hold the shares. They will be, let's say, more cautious. They will give more credibility for the market, as we are a financial institution that we make our homework and due diligence, and we believe in the company, and we would like to invest in the company way before it's publicly listed.
Rasha, do you feel the same way for the long-term success post-funding?
After going public, or after going public?
After funding, after receiving the funding and growth. So what do you think is the most critical factor for long-term success post-funding, and how can businesses prepare to maintain growth and stability?
Yeah, I mean, we always recommend that the leaders focus on their business for sure. They have to, one of the key issues is to keep a prudent financial management for the company. They have to keep an eye on that all the time. They have to invest in innovation. They have to be innovative. They utilize the technology to increase the efficiencies of their companies. They invest in talent management. So they basically have to keep in mind to maintain the performance, a good performance for the company. Of course, corporate governance, I go back to that all the time because this is what increases the confidence in the company.
Yeah.
So in VC, the first mistake you do is invest. Okay. Anyway, what we do at MEVP is, we have a classic funnel. We watch companies sometimes for years. Typically, before we invest, we would have, at least watched the company for 6 months, created a dashboard, gotten a lot of data to make sure we know how to monitor post-investment. Also, as part of our network at MEVP, we're one of the largest VCs. We're going to focus on growing the talent. Talent is problematic in the region, especially in big data and today in AI. I mean, AI talent is a problem in the US. So you can imagine what kind of hurdles we face from that perspective. Also, we help expanding into other markets. This is very important. Again, our theme is to create regional technology champions, and you need to be in the top 3 markets always to be able to exit correctly. Also, what we do is we try to instill some financial discipline. It's very important for companies when they receive VC money, which is very expensive money, very high IRR and highly dilutive, to spend that money very wisely. You want to at least spend the money over 18 months. We don't like to see rounds that are shorter than 18 months. And then, we usually get a board seat. The idea is not to control a company. We partner with business owners. This is very important. And we don't want to change that relationship. However, we have negative covenants. We have veto rights. Also, at MEVP, we've generated $1.6 billion of co-investment capacity. So we tend to give a lot of confidence to founders that will be able to, if we do their A, anchor their B. If we did their seed, do their A, and then start the B, and then continue, and then have them connect as these companies grow with international investors.
Yeah.
This is very important. We're getting a lot of attention now in the region. I just wrote something on LinkedIn 3 days ago. I don't like the term emerging markets anymore. It's very pejorative. I believe we are growth markets. And if you look at the GC specifically, no currency exposure, which is very rare in emerging markets. When I used to invest in India, 50% of the risk was currency devaluation.
Yeah.
A reasonably benign tax, tax regulation, hyper-connected people, 200% smartphone penetration, very high penetration of fiber to the home, bank accounts, home ownership, car ownership. So we digitized a bit late, but now we're really, moving forward. And we're getting money that used to be, for example, allocated to China. China used to be a very, very large market, especially for US and European funds. That is dropping, and there has been, a redirection of that capital. Initially, it went to Mexico for onshoring after Corona. Brazil got a lot of money, and now we're seeing that money come to the Middle East. So today, for the entrepreneurs in the room, it's the best time to be an entrepreneur. Our investment cycles, our growth, our path to IPOs are much shorter. And we have, finally, much more involvement from the sovereigns in what we do. So it's a great time to be be an entrepreneur. Also, to the women in the room, there's a factoid at MEVP. The first exit that I did at MEVP, we anointed 2 women as millionaires. We sold Shaye in 2014 to a Japanese listed company called Cookpad. And there were 2 women. Okay? So in VC, I know the data might be against you to the women in the, However, today it's great to be a woman either as an entrepreneur or as an asset manager. Okay? Again, I'm in VC. I'm always hopeful.
So ladies, if you need funding, you know where to find it. Thank you to my panelists. It was lovely. I had a lot of great insights. Thank you.